5 big stocks down big in the last week. Adobe, FedEx, Meta, Rowe, and Lumen Technologies. So we're going to go through these 5 stocks, quickly go through their 8 pillars, and the stock analyzer tool to determine what price we want to pay based on the assumptions here. So first stock, Adobe, down 23% in the last week. They made an acquisition. People didn't like that acquisition for $20 billion, and they went down because of it. So let's check it out right now on our software. So 294 is down another 2% today. Let's go right to the 8 pillars. Oh, wow, look at this, guys. So this is the kind of stock I like. Why? It's got check marks all over except for the valuation metrics. So what does that mean? It means the price needs to fall, the value needs to get up. One of those two things or both at the same time. These are the fun ones because you can add it to your watch list, figure out the price you want, and go from there. This is what I love. High return on invested capital. This company is really good at investing the money that's in the business to get higher returns. You should be willing to pay a higher premium for high return on invested capital businesses. Very low debt. Good Lord, they can pay off all their long-term liabilities with less than 1 year of their free cash flow in the last 5 years. And the other thing, free cash flow has grown. 5-year average is $5 billion. The last year was $6.9 billion. Let's go see what analysts are saying about the company. They're looking at EPS almost doubling in the next 5 years, with quite a few analysts here. Not every analyst out there is on here, but our data feed provides these. And then the revenue growth. Oh my lordy, I'm actually surprised by this. Low double digits, guys. This is great. So this is a company that's going to have, according to analysts, which you know how I feel about that, take it with a grain of salt, but these guys are actively involved with the companies and getting guidance from them. So I don't look at analysts for their buy, sell recommendations. I look at them for the estimates on growth. However, you still have to remember they can edit it all the way to the day before earnings. So let's go to Stock Analyzer tool and make our assumptions about the future on what we think the company is worth. Now, Adobe is transitioning their revenue stream from one-off sales to monthly subscription, which I love because their software is freaking awesome. Everyone loves Adobe software. It is the go-to. So when they're changing from buy this one time and have it for 10 years, now the subscription-based business, it'll allow people to get updates on their software. I freaking love it. So let's find the right price to buy for them. All right. So revenue growth we saw was low double digits. So let's go conservatively 4, 8, and 12. Profit margin, pretty consistently high. As you can tell, their profit margin has increased. Last 10 years, it was 26%. It's now consistently close to 30. So I'm going to go with 25, 28, and 31. Now, free cash flow, much higher than profit. I like that. Usually it's the other way around and you start to get worried. Why are there all these discrepancies? This is wonderful. Guys, I'm loving Adobe so far from a quantitative perspective on what I see from the company, merging quantitative and qualitative. But the question still becomes, can you overpay for Adobe? That is the key. And yes, you can. So we're going to find out right here. So let's go with 34, 37, and actually, let's go 34, 38, and 42, because as they go to the software business, their margins should be able to increase. So we'll check that out. Now, PE, I'm going to go 14, 16, and 18. And the reason being, it's a lot lower than they are right now. But remember, over a long period of time, the historical average is 15, but they do have a high return on invested capital. So I'm okay assuming a lower PE of 14. And for my desired return, guys, I'm going to go 12, 14 and a half, and 17. And here's why. I can get 9 or 10% from a low-cost ETF. So 12% is ample for a company this size with this kind of ROIC and with these low assumptions I've made. I mean, these assumptions are so freaking low. If it did this, I'm going to make much better than 12%. But as my assumptions get better, I want a higher return for bigger margin of safety. Let's hit the analyze button. The stock's currently at 294. All right, look at this. It's actually not as bad as I thought. We have a low of 120 to 160. Now remember, the reason for this big difference is look at the margin difference versus free cash flow difference. There's a big difference there, and that's why you have a value difference here. High side, it's actually almost there, 215 to 290. So it's probably more like right here. So I currently have the stock on my watch list at $200, and I like that price for the company. If I can buy it for $200, I think based on what I think about Adobe and its domination of their market, I'm good with that. So I have it on my watch list at 200. Mo, take over for FedEx.
FedEx. It's one of my favorite companies out there, as everybody knows. And Paul was like, you got to do FedEx. So looking at FedEx, the one thing that this is a very, very capital intensive company. Planes, trucks, anything that needs boats. I don't know if they have boats, but they ship around everything. So they have been decimated. They were down 20+%. I think the number was about 21.5% on Friday because they cut so much future guidance in half. And then they said beyond this quarter, which they report on Thursday, I believe, beyond that, they're not going to be giving any more guidance going forward.
Look at this. So Mo said they're a capital intensive business.
Yeah.
Mo, look at this. Their cash from operation. Look at free cash flow. I mean, it's not very good. It's only recently been decent. And fluke years because why? Shipping was very difficult.
That's the thing. And that's the thing. Like even when I come here to the income statement, point. I mean, you just see consistent increase, and then you go from 69 billion to 83 billion to 93 billion. I mean, that is an anomaly situation. And you can't say that that's going to sustain itself. And I think that's what the CEO came out and said. Even if you come down here and look at their net income, it's all over the board. I mean, you're 1.56 billion, 2.32 billion. Here you had 540 million. There are no losses in there, but it's very inconsistent. And that's something that I don't like. Let's go to, they are buying back shares, but again, they were buying back shares at expensive prices. This thing got to a pretty high number. What was that number?
Yeah, it's about 312.
Yeah. This is another thing that concerns me is this very, very low ROIC number. I mean, if you're going to take all that money and you need to invest it in yourself. Now, granted, like I said, it's capital intensive business, but 1.6 ROIC.
Well, that's why, I mean, the capital intensive business, it decreases free cash flow.
Yeah.
But look at this, guys. It was only 312 back in a year and a half ago. If I told you back then that a company like FedEx would fall in half, you'd be like, come on, you're crazy.
Yeah.
So anyway, what are analysts saying, Mo?
So these analyst estimates, I'm assuming they aren't updated as of last Friday.
Correct.
So you have to look at them and say, in the future, they're going to be doing revenue growth of 2.63% in 2027. But if everything stays where it's at with their guidance that they're guiding forward, I'm going to have to slash those numbers even more. So let's go to Stock Analyzer. Before I type in my numbers here, my number that spit out here 6 weeks ago was it was $175 on the low end. And but that was factoring in the way that they were, not going forward of what they're saying. I'm going to switch to dark mode just so you guys can see it a little bit easier as I type these numbers in. So revenue growth. Paul, you tell me if you think these are too high. Let's go. We're going out 10 years, remember. So I'm going to go with 1. I'm going to go with 1, 3, and 5.
Too high.
5 is high.
I'm going negative 2, 0, and 2.
Okay.
And the reason being, look at analyst estimates here, Mo.
Let me go negative 2, 0. Let me go 3 on the high side. What if they do?
They skyrocketed in the last 2 years. Like, is that sustainable? I don't think so. And they even warned that that's not sustainable.
It's not sustainable, but they were growing. They were still consistently growing.
I get that
until here.
But look at the overly optimistic analysts. They're at the low single digits. So I think to myself, okay, if a global recession happens and a recession happens here, they're going to have revenue drop, is my guess. And our goal as value investors is to make reasonable assumptions, but realistic ones. I think if you told me right now that revenue growth would drop 20%, I'd be like, okay, because I saw the big run up. So it's just like housing. It's like when housing,
so you can get the rundown.
Revenue skyrocketed and then fell. It's like, okay, it makes sense.
Profit margin. This is their ROIC. Everything continues to get more expensive. So I don't know if they can sustain this 4%, even though it's been sustained over the past decade, 1 year and 5 years.
So what's your thought?
I'll go 3, 3.5, and 4.
That's exactly what I was thinking, Mo.
Yeah. Free cash flow. Wow, it's much lower. 1, 1.5, and 2.
I think you're right.
Yeah. 1, 1.5, and 2.
And I think 2 is going to be hard to sustain.
Yeah. PE. Now, I'm going to put them, 10, 12, and 14.
God, that's exactly what I was thinking. And the reason I even gave 10 for negative 2% growth is because of FedEx being FedEx. It's like, okay, they deserve some sort of premium for being the shipping company out there.
I mean, they do ship well sometimes. All right, return. I'll go with 12.5, 15, and 17.5.
I think that's great.
All right, let's see what it spits out.
$4.
$4. Should be $4. Let's see. If you go multiple of earnings, $82 to $120. Discounted free cash flow model, $28 to $62. And look, previously I was sitting at $175. and we pretty much cut everything in half. So,
and by the way, that's the key here. As a value investor, you have to make your decisions based on new information coming up. And the CEO just announced all this new information saying, listen, we're scared. Things are not looking good. That is new information. So Meta, Facebook, the whole thing, they own Instagram, they own WhatsApp. They have 3.5 billion people actively every month using their services every single year. This is stock has been down a ton, 52-week high of 361, low of 144. We're almost at the low today. It was, might have hit the other day. So 8 pillars. Oof. 8 pillar thriller.
Yep.
All right. Low debt, buying back shares, low PE, low price of free cash flow, high ROIC. Do I need to go any further? Yes, I do. Now, the issue with Facebook/Meta. There's a lot of negativity out there. I just saw a professor, by the way, I love that a professor is saying this, that said Mark Zuckerberg needs to step down as CEO because he's leading the company down the wrong path. He might be right, but they're making a lot of investment into Meta, the metaverse. They're spending $10 billion as of right now a year on that with no return, basically. So there is a long-term investment in Facebook. Let's see how it can play out. Let's look at analyst estimates. Now, the reason analysts still have the company growing their EPS is 1, buying back shares, and 2, I don't think they've maximized their revenue and profit per user. And that's my kind of idea behind Meta. In terms of revenue growth, look, this dead company is supposed to grow low double digits according to analysts. And there's a lot of analysts watching this. Are they right? Are they wrong? I don't know. But I like to use analyst numbers as my high end on my stock analyzer tool. So let's go right to it. Stock analyzer tool. 10-year analysis, revenue growth. I'm going to do 4, 8, and 12. Profit margin. I'm going to do 25, 28, and 31. Free cash flow margin. I'm actually going to do the exact same thing, even though free cash flow is higher. Now, PE. Do 12, 15, and 18.
Good.
Because I think at the tail end, if they do this well, it's probably because Meta worked for them and they're making a lot of money and they dominate the metaverse. Look at that Oculus. I mean,
today's September 19th. I think October 6th, they're coming out with Oculus 2 announcement.
It's awesome.
Oculus 4 or 3 or whatever it is.
And I'm going to do the same thing that Mo did on desired return, 12.5, 15, 17.5. The stock is currently at 146. All right, we have a low of 133, a high of 257, a middle of 190. And guys, we do all these stocks all the time, and we change our assumptions about things as we go along. But the key for you should be to look at, I'm falling right in the same area. And just like Warren Buffett and Charlie Munger say, if you ask either one of them, what's Berkshire Hathaway worth, they're going to come up with different numbers at different times. But the point is, overall, they're probably somewhere in the right ballpark. So next stop, stock, Rowe Price. Mo, take it.
This has been on our list for watching for a very long time. This is another one. This company is down 8% in the last 5 days. Now, they're in this financial advisor segment. I have to think, when I'm starting to do stock analyzer and pricing this in, and we'll see what the analysts say, I have to think that as people get scared, as people get worried, they're either going to run to financial advisors or they're going to run away and keep money in cash. So you have to look at it this way, especially if we are going into this recessionary environment. But right now, 8 pillars all across, great ROIC. They're buying back shares. Their debt is very low. Their free cash flow is, their free cash flow is good. Everything's looking really good here.
Now, what's the issue with Rowe Price?
Well, the space that, I don't like the space that it's in. That's my thing.
What's that space?
This financial advising space.
However, but why don't you like it?
Because it's not, technically, yes, it's a cash flowing business because you're taking fees and whatnot. But I worry about the consumer sentiment and that direction that goes. You could argue that.
So I think Mo's great. No, I think you bring up a good point, Mo. But my point is, this is exactly why I want to watch this company. Because if I believe the market's going to do what it's going to do, this is exactly the company I want to buy when sentiment on the markets is bad.
Down and people.
When the markets are down a ton, people are going to beat this company up like crazy. And that's what I want.
Great point.
I am watching this company all along the way as it goes down because Rowe is a great brand, a great name in 401ks and investing. I love that.
And if you look right during COVID, right in the middle of March of 2020, $85.50 a share was that low. So look at how, what was its peak? $218?
Yeah.
Unbelievable. Okay, let's look at these analyst estimates. So EPS, 6% on EPS, and look at the revenue growth. Revenue growth, it's pretty stagnant, don't you think?
Oh, yeah, very much so.
Yeah, it's stagnant. So, okay, let's run Stock Analyzer on this.
And I think, by the way, the EPS is probably too high because again, they're probably not factoring in stocks falling like we think.
I
probably
guarantee
in
if
half.
you go and look at anything that Rowe Price is saying, they really can't say that. They're in the business of keeping clients. So let's look at, let me see, what was their high end for revenue growth? Their high end was 2% long term. So let's put in the same numbers, -2, 0, and 2. Profit margin, very high profit margin. Let's go with 32, 33, and 34. Free cash flow margin, wow, that's kind of all over the place. Look at the free cash flow in the last year, 43%. I'm going to go 25, 26, 27. PE, 11, 13, 15. Price to free cash flow, I'm going to do the same number on that one. And I'm going to put in my return of 12.5, 15, and 17.5%. Let's see what we spit out. Do you remember your number on this one, Paul?
I was watching it to pay attention to it under 100. Doesn't mean I was going to buy it under 100, but it was where I was going to start paying attention and maybe start selling some puts below those prices.
Pretty much where we're sitting. I mean, it's $112 currently, and you're looking anywhere between the two, $62 to $94 a share. So it's sitting right in that range. It's consistent with what we've been saying for a long period of time.
Yep. Final stock, Lumen Technologies. Guys, this one's down 10% in the last 5 days. It's down a lot. In the last year, it's down from 1450. Let's see what the all-time high is. Back in oh, look at this, guys. I love this. In 1999, it hit $47, $48 a share. Saw it once back in 2007. Hasn't seen it since. Let's look at the 8 pillars. Wow. Shares outstanding. My guess is there was an acquisition, and they probably increased shares to make some sort of acquisition. No PE. Very low price to free cash flow, though. That's probably the attractive part here. Very low price to free cash flow. Revenue is down $2.2 billion. Free cash. Oh boy, this is a tough one, guys. Analyst estimates. They actually have. Oh my God, look at this. I'm avoiding this. This immediately. Revenues dropping, profits dropping. They still have debt. Guys, I'm not even looking further on this company. This is what I look at for a value investor. My goal is to save myself time. If I see the 500-foot view and I see a company going, what the hell is going on here? I just avoid it. Thanks for watching this video. If you like this and you like our 8 pillars, you need to watch our next video on our 8-pillar process. Don't forget to subscribe. Thank you very much for your time.